Understanding how to distribute ownership in an LLC is crucial for business founders. Unlike corporations that issue stock, LLCs distribute ownership through membership interests, creating a more flexible structure with unique advantages and considerations. LLCs, or limited liability companies, are semi-formal businesses formed at the state level. They offer the liability protection of corporations while maintaining the tax benefits of partnerships. This hybrid nature makes them popular among small business owners seeking simplicity and protection. When it comes to ownership, LLCs distribute membership interests rather than stock shares. These interests determine each member's rights, voting power, and share of profits. The ownership structure must be clearly defined in the LLC's operating agreement to prevent future disputes. Unlike corporations, LLC ownership is typically established before the company's official formation. The names of initial owners must appear on the articles of organization when filing with the state. While membership can change over time, most states require LLCs to update their filings annually or when ownership changes occur. There are several methods for distributing membership interests in an LLC. The most common approach bases ownership percentages on capital contributions, where members receive ownership proportional to their financial investment. However, LLCs can also distribute ownership equally among members regardless of contribution amounts, or allocate interests based on services rendered rather than financial input. Some LLCs implement vesting schedules where ownership is granted over time based on performance or continued involvement. Whatever method is chosen, it should be thoroughly documented in the operating agreement. LLC membership interests have several distinct characteristics. While most states require equal rights among members, the operating agreement can specify different classes of membership with varying voting rights and profit distributions. This means profit sharing doesn't necessarily need to match ownership percentages if the operating agreement specifies an alternative arrangement. Interestingly, cash contributions aren't always required for ownership. Members can receive interests in exchange for services, property, or other non-cash contributions. The operating agreement can also detail how assets will be distributed during liquidation, providing flexibility beyond what's available to corporations. Transferring membership interests in an LLC is more restricted than selling corporate stock. Most operating agreements require approval from existing members before interests can be transferred to outside parties. Common provisions include right of first refusal clauses, where existing members have priority to purchase departing members' interests, and majority approval requirements for any ownership changes. From a tax perspective, LLCs have pass-through taxation by default. This means members report their share of profits on personal tax returns, even if those profits remain in the business. This differs from corporations, which face potential double taxation on distributed profits. Legal considerations are equally important when distributing LLC membership interests. While most states don't require operating agreements, having one is essential for documenting ownership structures and avoiding conflicts. Some states require reporting ownership changes through annual filings, and certain fundraising methods might trigger securities law compliance. To properly distribute membership interests, start by determining each member's contribution, whether financial or service-based. Document the agreed ownership percentages in a comprehensive operating agreement that includes profit distribution methods, voting rights, and transfer restrictions. Consult with legal and tax professionals to ensure compliance with state regulations and optimize tax treatment. Understanding these fundamentals of LLC ownership distribution helps founders establish clear expectations and prevent disputes as their businesses grow. With proper planning and documentation, an LLC's ownership structure can provide both flexibility and protection for all members involved.